Good morning, everyone. I'm pleased to welcome you to today's live webinar, Why Moats Matter Going Forward. My name is Hannah and I'm a part of the team here at VanEck. A reminder before we get started, today's webinar is being recorded. So if you do miss out on any sections, you'll receive a link to the recording tomorrow. What is presented today is general in nature and is not personal advice. It's important to consider whether a particular fund is appropriate for you and what you're looking for. For details and more information for any of our funds, the best place to go to is our website, vaneck.com.au, where you can find the product disclosure statement and target market determination for each of our funds. There is some additional information at the end to have a read of. On the screen at the moment is some important information from Morningstar. Just want to reiterate that today the information is for educational purposes only, and I'll also have this disclaimer at the end of the presentation if you'd like to have a further read. Many of you will know a lot or a little bit about VanEck, but for those who may be new to us, we are a leading ETF provider with 32 ETFs on the ASX, many of which are award-winning and highly regarded among advisors and investors alike. We draw on our long-standing heritage, the global heritage, been around since 1955, and bring the best quality investment solutions to clients by offering a beyond the usual approach to established investment categories and opportunities to access asset classes, new asset classes, or those often underrepresented in portfolios. In the 45 minutes we have today, first we're going to cover the context we're in. We'll explain the moat investing philosophy and why it matters, especially in this environment we're in. We'll go through how Morningstar put together their wide moat indices. We'll go through our two wide moat ETFs, MOAT and GOAT, and provide a performance update. Morningstar will give us their take and analysis on two stocks within each of these ETFs. The final section of today will be a Q&A. So to ensure you get the most out of today's webinar, please make use of the Q&A function and ask any questions you have, and we'll make sure we get to them in the final part of today. We are delighted to have Andrew Lane and Campbell Stevens with us today to take us through moat investing. Andrew is the Director of Equity Research in Index Strategies at Morningstar. And Campbell is our Business Development Manager, looking after Victoria and Tasmania. Welcome to you both, and Campbell, I'll pass it over to you to talk us through the big picture.
Thank you, Hannah, and good morning, everyone. So what we're going to run through quickly is the current state of play. Undoubtedly, everyone on this webinar is aware that inflation is running at multi-decade highs. So let's look at how markets have behaved over the last year. So from Jan 22 is where this snapshot begins. And in essence, what's happened is inflation has become quite an issue broadly throughout the world for a multitude of reasons. We've obviously had government's fiscal expenditure go to nuclear levels, as well as monetary policy down at about 0.1% at the depths of COVID. And what's happened is that's created supply and demand issues, along with a war in Ukraine, which has led to elevated inflation and has caused central banks to raise interest rates. And as those interest rates have come up, all other asset prices need to be revalued over that time period because the risk-free rate of return is adjusted. Simplistically, if you're looking at two different asset classes and one's safer and yielding you the same amount, then theoretically you'd be changing asset classes to the safer version that's yielding you the same amount, which is where that repricing of broader assets has come through from January 22. You've found that the rising expectation in yields has led to lower values of equities, broadly speaking. That actually finished up in June 22, where there was a market rally, a bear market rally, for lack of a better term, where there was hope within the broader market that there was going to be a turn from the Fed or a pivot, which was quickly stamped out in September 22, where Jerome Powell came out and said, the reality is there is more pain to come. We are just beginning our fight against inflation, and we do not want it to become sticky. That only lasted a short period of time to November 22, where we had weak US economic data and the reopening of China. And people tended to forget that there was likely to be earnings revisions at the beginning of 2023. Then the US economy became quite resilient for Feb and January and February in 2023. Record low unemployment remained. Sticky inflation was coming through, particularly on the services side, which led to the thought process that the Fed would have to go higher for longer. The setup of this story really has been going for about 40 or 50 years. If we take a look at the chart on the far left-hand side, back to 1975, this was the Arthur Burns period, where no Fed chair really wants to be remembered in the same light. Inflation was running hot, there was a pivot, and inflation came back. And the person who stamped it out was Paul Volcker, and I'm sure you've read all about the stories of interest rates at 20%. Some of you may even have bought your houses at such high interest rates. My parents definitely do not allow me to forget the interest rates of that period when they first bought their houses. But over that 40-year period, rates have trended down. And as I mentioned, over the last year, we've had that fiscal and monetary firepower that has almost slingshotted the whole economy out of the COVID lows. And this could cause issues. So it's been a really volatile investment period for the last year. And I think it's very interesting to sort of hear about potentially what Andrew is going to talk about, moat investing, and how that could be coming to the fore. So Andrew, maybe you could talk to us about how moat investing is working in this current environment.
Great. Yeah, thanks a lot, Campbell, and thanks everyone in the audience for taking the time to join us today. So again, I'm Andrew Lane. I'm actually a Morningstar employee. And so as a member of Morningstar's equity research team, our equity analysts are the ones who are effectively determining which stocks go into and come out of this index each quarter, right? So effectively, it's the work and the research of our analysts that has really been sort of driving performance over time. And happy to talk a little bit about the prevailing economic environment as we go, and as we walk through a few individual stocks that have been holdings of the Morningstar Wide Moat Focus Index and have impacted performance. But first, here's just a snapshot of our coverage across our equity research team at Morningstar. As you can see on the bottom left, we cover right around 1,500 companies, really around the world. Towards the middle, our coverage does skew towards larger companies, and by and large, for a strategy like this, where we're focusing on companies with a wide economic moat, you tend to see wide economic moats more often in the large cap space. It's just not as common to see companies with very strong, durable competitive advantages in the mid cap or especially the small cap space. So again, most of the stocks that we'll talk about today, and most of the stocks in this fund are larger across the cap spectrum. And then lastly, on the right, we cover stocks across all the major economic sectors. So moving forward from this slide, there's really two data points that determine whether a stock is in this index or not. The first is our economic moat rating, and the second is valuation. And so first on that first data point, the economic moat, we have a very sort of thorough methodology that we use to try to determine what a stock's economic moat rating should be. And by economic moat, really what I'm referring to is the degree to which a company has a competitive advantage that will prove durable over time. And so the exhibit here really relates to that definition. To say a company has a wide economic moat, we have to believe with near certainty it will out-earn its cost of capital for the next 10 years. And then more likely than not, it will do so over a full 20-year period. And of course, when you're looking forward 20 years in the future, it takes a lot of conviction to say that a company's competitive advantage will prove durable. And so wide moats are rare, even across our coverage. And so again, it's a very distinguishing characteristic, and every firm in the wide moat focus index, of course, given its name, has that wide economic moat rating. So that's the first thing that matters here is the moat rating of the companies, and focusing just on those wide moat businesses. And then onto the next slide, just to go a little bit deeper in terms of how we identify durable competitive advantages. What we do is we really look for at least one of these 5 economic moat sources. And so, the question really is, does at least one of these moat sources exist when we look at the business models of all the companies that we cover? Certainly, a company could have more than one moat source. For example, Amazon enjoys intangible assets from its wealth of useful customer data. It enjoys a network effect from its marketplace platform that it offers. And then it enjoys a cost advantage from its really strong economies of scale that are far stronger and far higher degree of scale than really any of its competitors. But again, all we really need to see is at least one of these moat sources present. And then the question is just how long will it prove durable? How long will it persist into the future? And so at the end of the day, the moat rating really is a reflection of quality on a forward-looking basis. Certainly it matters to us, what returns on capital a company has generated historically. It matters to us, just how profitable a company has been historically. But the question really is, will that persist in the future, and how long can that be expected to persist? Just a couple more quick examples to drive home the point of how this works. Intangible assets. This is typically, patents or brand equity, each of which leads to pricing power. So think about a company like Coca-Cola, for example. Some, at the risk of oversimplifying, might say that Coca-Cola really sells a commodity. It's sugar water. But at the end of the day, Coke has maintained a very strong pricing premium over other carbonated sugared beverages for many decades into the past. And we believe that'll persist for decades into the future. And then just maybe one more example here, switching costs. So switching costs are evident in a number of different sectors and industries, but perhaps none more than software. And so Salesforce.com, of course, is a great example of a wide moat company with very strong switching costs. And this is where, if someone embraces Salesforce software solutions, by and large, they'll find that it's actually more costly and more onerous to switch to a different software supplier, even if perhaps that alternative solution is lower cost, just because at the end of the day, they risk a huge disruption to their business. They perhaps would have to retrain all their employees on the new software. Perhaps they risk losing valuable data that's critical to run the business and to drive future growth. And so they end up sort of stuck with that inertia to that incumbent supplier. And that really exemplifies switching costs very well. So just a couple quick examples of how the moat methodology works. But of course, as I mentioned before, that's just one piece of the puzzle. The other key element here is valuation. We don't think it's enough to just invest in a basket of wide moat companies and forget about valuation and expect to beat the market. So we want to invest in really quality businesses with these durable competitive advantages, but we want to make sure we're doing so in a very disciplined manner, and ideally taking advantage of market dislocations where we can find them. And so, for example, on the bottom here, you can see just an example stock that we might cover. Maybe our fair value estimate is that horizontal teal line. $11.50 is the fair value of the company, or the intrinsic value of the business. We have a quarterly reconstitution process whereby we'll try to include the most undervalued U.S. wide moat companies we find, and then exclude those that are most overvalued. And so for this stock, you can see where it's dark blue. Those are periods where it would be far more likely to enter this portfolio. And then, of course, where we have the stock price actually above our fair value, if this stock were a holding, it would likely be removed in favor of a different stock that is undervalued. Or if it's not yet a constituent of the index, it certainly wouldn't make the cut when it's overvalued. So again, it's not just enough for a company to have a wide moat. We also need to make sure that it offers attractive returns and a really attractive return profile to investors. And those are the key pieces. And that all comes together here on the exhibit you see on this slide. This is how the actual index is constructed. So with step one, we start with the parent index, really, which is the Morningstar US Market Index. This parent index captures about 97% of total market cap in the US. And that's really a stock has to be a constituent of that index to make it into this fund. Second would be the quality element, which of course is that economic moat rating. And this is, again, we're really just screening for companies with a wide economic moat. So sort of the cream of the crop when it comes to business quality on a forward-looking basis. Step three incorporates valuation, as we just talked about on the prior slide. This is where we take all the US companies with a wide moat rating that our analysts cover, and we make sure that we're only investing in those that are most undervalued. So the securities get ranked by really just one metric alone, and that's the price of the stock compared to our analyst-driven fair value estimate. And then step four is really sort of just the maintenance of the portfolio. So there is a quarterly reconstitution and rebalancing process. So this is not a cap-weighted index. It is an equal-weighted index. And really each quarter, we are adjusting a portion of the portfolio and always making sure to cycle in wide moat companies that are undervalued and perhaps cycle out those wide moat companies that no longer offer the attractive returns. And so right now, we're at 49 securities. Typically, it's going to be somewhere between 46 and 50 securities.
Thanks, Andrew. That's a really good overview of how the index works. Just so everyone is aware on the webinar, you can't invest directly in the index. So the only way that you can access this opportunity is through our ETF with the ticker MOAT. That's the ASX code, is MOAT. The fund's been live since June 2015. It's 0.49% for its management fee. As Andrew mentioned, there's currently 49 stocks. There can be anywhere between 40 and 80. The underlying constituents are equally weighted. And we've got over $500 million in funds under management within that Aussie listed fund. So just a quick overview. It's wide moat stocks with a valuation bias run by Morningstar's equity research team. From an equity exposure or sector exposure perspective, the fund has been really dynamic through its lifetime or since inception. You can have a look at the sandbox there. At any given time, something is the largest weight and another sector is the smallest weight. There is no particular sector that's overweight through that whole period. So it's got some really nice idiosyncratic style bias relative to the broader market. And when we have a look at the investment performance, the alpha, the drawdowns, and the broader volatility. So as I said, the fund has been live since June 2015 on the ASX board. It's outperformed by 2.76% per annum since inception, which really, to Andrew and the team at Morningstar, it's quite a phenomenal result to outperform the S&P 500 by any amount, let alone by such a vast amount over that time period. So congratulations. The drawdowns obviously been superior through most time periods as well. If we have a look at November 2018, March 2020, and July 22, which is quite attractive from a drawdowns perspective, and volatility wise, again, it's been relatively in line. So Andrew, maybe you could provide a bit more color on how the fund has performed through a range of market cycles.
Sure, absolutely. And so on the left here, we're showing the performance of the index itself relative to its parent index, the Morningstar US Market Index, but then also the S&P 500. And as for those latter two indexes, you can see that over time their performance is, very, very similar. But the Wide Moat Focus Index has outperformed over every period shown. And we'd reiterate that the actual live inception date for the index itself was all the way back in 2007. So we're looking at a very lengthy track record here of outperformance, right? Over 300 basis points of of annual outperformance relative to, whether you want to use the parent index as the benchmark or the S&P 500. And so that's a track record we're proud of. On the right, we're really just showing trailing 3-month excess returns. And as you can see, the story really just is that the excess returns have come from just about every economic sector, right? It's not sort of concentrated in one particular sector over time. And so that's nice to see, right? That we're not, this is not an index that takes very, very concentrated sector bets. We certainly are willing to have sector weightings above and below those of the benchmark, but there's actually a constraint in place whereby no sector can be above 40% in terms of total portfolio weighting. We rarely ever come close to brushing up against that constraint, but at the same time, it just is there to ensure that we're really letting the stock selection drive returns. And it's really that stock selection from Morningstar equity analysts that has driven the favorable returns over time. So on the next slide, this is a quick snapshot of the changes that took place at the most recent quarterly reconstitution. So this is an index that reconstitutes on the third Friday of the final month of each quarter. And so the most recent reconstitution was Friday, December 16th of 2022. So for that quarter, we observed slightly lower turnover than typical. Only 6 of the stocks in the sub portfolio that was reviewed were replaced by new holdings. So I'd say it's more typical to see maybe 7 or 8 stocks turnover. And as recently as the prior quarter, the third quarter of 2022, actually 10 stocks had been replaced. So in looking at the added and removed constituents, we saw 2 tech companies enter. That's Fortinet and Monolithic Power Systems. Additionally, 2 financial services firms were added. That's TradeWeb Markets and US Bank Corp. Rounding those 6 out, International Flavors and Fragrances, and then Dominion Energy. And then as for the 6 removals, I think typically the overwhelming majority of stocks that get removed from the index really comes from that valuation screen, right? It's not that the wide moat rating goes away. It's more just that the valuation of the stock is fluctuating, or perhaps our fair value estimate is fluctuating. And so that's going to drive, maybe 90% of the turnover is valuation, not changes in moat ratings. And so when it comes to valuation being the cause for turnover, you can see that's the price to fair value column. That was the case for Honeywell, BlackRock, Charles Schwab, and Gilead Sciences. Intel was actually removed due to an economic moat rating downgrade from wide to narrow. So while those downgrades are relatively rare, they do happen from time to time. And then Guidewire Software actually was removed because it failed a liquidity screen based on the size of its market cap. So in light of this most recent reconstitution, the index actually remains pretty squarely in the large blend style box. It has an ever so slight bias towards growth at the expense of value. But again, it's pretty consistently over its 16-year live track record been pretty squarely in that large blend category. So having touched on some portfolio level observations, let's talk about some individual holdings that have impacted recent performance. And we'll start with Berkshire Hathaway. This is an appropriate stock to start with because really when you take a step back and think about our economic moat methodology as a whole, the person to coin the phrase economic moat was actually Warren Buffett himself. And so Berkshire Hathaway does have a wide moat. Warren Buffett, of course, built this company much in the way that we build this portfolio each quarter, right? He likes companies with durable competitive advantages, and he tries to be selective about when to add them to the Berkshire portfolio. So as you can see here, over a trailing 1-year chart, Berkshire was fairly valued about a year ago, and then traded off a bit lower over the course of 2022, as so many stocks did. Whereas our fair value over most of 2022 was relatively stable, at least after the first quarter, and it remains undervalued at this point in time. So when you think about Berkshire, its decentralized business model and broad business diversification, along with just the high amount of cash generation that it's capable of, plus its unmatched balance sheet strength, they're big differentiators for the firm. Its economic moat is really more than just a sum of the parts of the individual businesses that comprise the company. Although the parts that make up the whole, insurance, railroad, energy and manufacturing, also retail operations, these all tend to be narrow to wide moat firms in their own regard. And all of the excess capital that's generated by these operations are really funneled up to the corporate level for reinvestment. And of course, the company has a very strong track record in terms of reinvesting that capital in investments that generate high returns. So the company really has generated very consistently strong excess returns over much of the past 5 decades. And that's really an impressive feat given the amount of M&A that the company does. And finally on Berkshire, we just highlight that it's still trading at about a 20% discount to our $370 per share fair value estimate. The company has ushered in a lot of cost controls during the pandemic that are starting to bear some fruit. And its cash balances are down significantly year over year, which suggests that share repurchases are likely to be limited in the near term. But the company is still going to be probably has the capacity to repurchase about $6 billion of its stock annually. So it has multiple ways and multiple levers to use to return capital to shareholders. So it remains a holding in the Wide Moat Focus Index. The next slide is Alphabet. Certainly this stock has been in the news a lot recently. And anytime a stock is in the news a lot, that's always makes it a little bit more interesting to us because a lot of times the news flow related to a company ends up impacting the valuation of the stock, but it's not always clear to us that there's a really direct linkage between adverse news flow and actual shareholder returns or profits for the company over time. So again, as you can see here, over the last year or so, we've had sort of a steady march lower gradually for the stock. Our fair value estimate has also decreased a bit over the trailing 1 year period, but the stock remains quite undervalued now. When you think about the wide moat associated with Alphabet, the moat sources here are the network effect and the intangible assets associated with customer data. This is a two-sided network effect. Of course, the more searches are conducted via Google, the more the search results improve, and then the more beneficial the tool is, not just for new users, but also current users. The same network effect can apply to YouTube for Google, which we think is a really valuable asset. So the network effect is very strong for this business. Why has it underperformed over the trailing year? Well, of course, broadly, the Fed's moves have, in terms of raising interest rates so steadily and by such a high magnitude, has lowered multiples across, of course, the full market, but especially the tech space. But Alphabet's now trading at multiples that we view as far too low for a company with operating margins in the mid to high 20% range that's still a clear leader in its market. This is an exciting company to talk about right now because, of course, its search leadership is being questioned with the emergence of ChatGPT. But we really feel strongly that Google has more than enough capital at hand to ensure that its own Bard AI-based search solution will ultimately prove at least comparable, but more likely superior to ChatGPT. So certainly, I think it's interesting that that search threat has emerged in the form of ChatGPT. But I think that we really feel that it's not going to prove quite to be as financially material a threat to Google's bottom line or to Alphabet's bottom line as I think many market participants would otherwise believe, and certainly as the media would have you believe. So with all of that said, what I think will turn the market's view of Alphabet over time, the catalysts that are key would include first, again, indications of cost control. You've likely read about significant layoffs, at Alphabet in recent weeks. The solid growth of its cloud business, which tends to get a bit overshadowed by a lot of the news flow that we've seen. The cloud business has been performing very well and remains a highly attractive business that sets the stage for really strong cash flows in the future. And then third, the difficulties that the U.S. Department of Justice is likely to have with its antitrust case against Google. You have more things like ChatGPT emerging. You have Amazon and Apple competing more actively in spaces where Google used to be sort of the only show in town. That makes the case for antitrust litigation a lot less compelling. So overall, the stock's trading at about a 40% discount to our fair value estimate of $154 per share. It remains a full weighting in the Wide Moat Focus Index, and we're excited about its prospects. And then, of course, we've been talking about the Morningstar Wide Moat Focus Index this entire webinar, but it's important to note that, at Morningstar, we actually have a family of funds with VanEck. So we've partnered with VanEck across a number of different efforts that are underpinned by Morningstar indexes. And another exciting one is the Morningstar Developed Markets ex-Australia Wide Moat Focus Index. And so as you can see here, we've already talked about the performance of the Wide Moat Focus Index, which has been very favorable over time. But of course, the Morningstar Developed Markets ex-Australia Wide Moat Focus Index, as you can see here, also has a very favorable track record. While it, of course, focuses on a different approach geographically, the underlying approach in terms of really just including companies with really strong competitive advantages that are undervalued remains very much the same. So it has very much the same DNA as the Wide Moat Focus Index, and accordingly, perhaps not surprising that the performance looks very similar.
Perfect. Thanks, Andrew. So again, you can't invest in the index directly. So the way that you would get exposure to the global moat or GOAT, more affectionately known as the greatest of all time within the firm, is via the ETF with the ticker or the ASX code GOAT. It's been around since September 2020. It's 0.55% for its management fee. It's got anywhere between 50 to 100 stocks, again, all equally weighted in the underlying portfolios. It's high conviction, very similar style bias to Moat, with the attractive valuation overlays. You still get the Morningstar equity research team, but it's a global exposure. So Andrew, maybe you could, just before we wrap this up, run through another two stocks that would be within GOAT's portfolio, just to give people a better idea of how this fund works as well.
Yeah, absolutely. So two more stocks to highlight, and then I think we'll go into a brief Q&A. So first, a holding in this index is Airbus, and again here on the chart you can see that over the last year this is a stock that while it has appreciated modestly amid despite a couple drawdowns in mid to late 2022, this is a stock that has eked a little bit higher over the trailing year, but still remains significantly undervalued in our view. Airbus, it earns a wide moat rating based on the durability of its intangible assets and switching costs that are associated with its products. Airbus is the dominant partner, in our view, in a commercial aerospace duopoly. The company's A320 family of aircraft, it really splits the traditional narrow body market with Boeing, and is actually gaining share in the attractive medium haul market. So Boeing and Airbus supplied more than 99% of the commercial aircraft deliveries between 2000 and 2022 for aircraft with more than 130 seats. So when we suggest it's a duopoly, very much that's the case. Our fair value for Airbus is $153 per share. And the stock's trading at about a 25% discount to our analyst fair value there. Obviously the COVID-19 crisis shocked the aviation industry. So we expect global commercial air travel to recover to 2019 levels by the end of 2024. So we've seen a very significant dip, but as soon as 2024 year end, we'll be back to where we were prior to the pandemic. Beyond the pandemic, we assume steady revenue passenger per kilometer growth. We expect GDP growth should drive really healthy growth, especially in emerging markets for Airbus. And then we also incorporate an ongoing replacement cycle for older aircraft in our model. The vast majority of fleet growth will really be from narrow body aircraft, and that's from emerging market middle class demanding more short haul travel, and so that plays right into Airbus's hands. Overall, we think operating margins, which are pretty much equivalent to Airbus's adjusted operating margin EBIT metric, will improve to about 12.5% at a mid-cycle level versus just 8.5% in 2022. So we think perhaps the market underappreciates the amount of margin expansion that the company really will be able to usher in. And then on the final stock suggestion or example of the webinar here, GlaxoSmithKline. And so again, this is a stock that, as you can see, it remains quite undervalued. Our fair value estimate over the trailing year has been relatively steady. It's ticked up a bit. The stock has been pretty flat. And this is a case where patents, economies of scale, and a really powerful distribution network support GSK's wide moat. Its patent-protected drugs carry really strong pricing power, and that enables the firm to generate returns on invested capital above its cost of capital. That's been the case for quite some time. We think that'll be the case for quite some time in the future. And the patents give the company time to develop the next generation of drugs before generic competition comes in and challenges the company's margin and profitability profile. So in terms of valuation, it's trading at about a 40% discount to our fair value estimate of 2,200 GBX per share. The stock is, of course, undervalued, with, I think, the market overly concerned about litigation related to one of GSK's drugs, Zantac, and perhaps not appreciating the company's steady growth outlook, which of course ties back into the company's wide moat. So there are some longer-term patent losses that will start to emerge in 2027, but we actually like the company's pipeline quite a lot, and the new drugs, the new candidates should offset that some of those patent losses. The company's RSV vaccine has reported leading efficacy and will likely be one of the first RSV vaccines to the market. That's exciting for the company. And then, we overall really are just looking at annual sales growth over 5% for the next 5 years, with some exciting new products offsetting generic competition entering as some patent losses hit the pipeline. Again, steady growth from vaccine should reduce the volatility from those patent losses. And so again, this is a really, well-run company with a strong patent-protected portfolio of drugs and exciting candidates in the pipeline.
Thanks, Andrew. I think we all found the individual stock analysis and the overview of the wide moat indices performance really interesting. We are now up to our Q&A section of today. So thank you to everyone who's already sent some through. Just continue to use the Q&A if any more pop to mind. The first question we might do, I might direct to Campbell. We've got, what is the impact of exchange rate between US dollar and AUD on the returns of Moat and GOAT?
Okay, so both of the strategies are unhedged, particularly with Moat. Really, if the US dollar strengthens on a relative basis, the performance looks much better in dollars. With GOAT, there are a range of different currencies in it. But again, the US dollar is the broad majority of it. I think it's about 55%. So you'll find a stronger US dollar will look on a relative basis really good against the Aussie dollar and vice versa.
Great, thank you, Campbell. Our next question, maybe for Andrew, we've got, does valuation attractiveness affect moat ratings? So I think just talking to, are they separate? Interaction, that would be great.
Yeah, that's it's an important question. So the degree to which a company is undervalued or overvalued, right, just simply, its valuation relative to what we think it should be trading at, that does not impact the moat rating in place. So certainly there are many wide moat companies that are significantly overvalued at any given point in time. And then, of course, those that are most undervalued are the ones you'll find in this very strategy. So while the valuation does not necessarily impact the moat rating, I'll turn it around and say the moat rating we assign actually does impact how we value the business. And so in other words, if we think a company has a wide economic moat and it's earning high returns on capital, well, what we're really suggesting is if there's a moat there, those high returns should persist for a very long period of time. If a different company has that same high return level, but we don't see any sort of sustainable or structural competitive advantage that will protect those high returns, maybe they're more likely to fade more quickly over time. And so no matter how high those returns are at the beginning of our forecast period, we're probably going to forecast that they're going to decline much more quickly, and maybe economic profits will disappear altogether. And so the moat rating does tie in with how we value the business and the decisions we make in forecasting cash flows. But the valuation relative to our fair value really has no impact on how we think about the moat. It's really just the moat and the durability of the competitive advantage will impact how we value the company in the first place.
Thanks, Andrew. Our next question we'll do why, maybe for Campbell, if you can answer this one. We've got, why is MOAT annual dividend yield only 0.99%?
Yeah, sure. So typically what you'll find with ETFs is the yield is representative of the underlying yield of the assets that ETF holds. Australia is quite different to a lot of other markets in the fact that we've got a very high distribution rate, whereas in the US, you'll find that that's a pretty typical yield of a US equity fund. So that's in essence really what it is a representation of the underlying equities that it holds, and that's the broad yield of that bucket of securities.
Thanks.
And if I could just maybe layer on a quick comment there, is particularly in the US over the last, especially over the last decade, management teams have been turning to share repurchases much more actively relative to dividend hikes. And so obviously that's just a different way to return capital to shareholders, but it's become an ever more popular lever for management teams of US companies to pull relative to, just trying to, put a high dividend yield out there in terms of where your stock is trading.
Thanks, Andrew. The next question we might do, so this is sort of a broad macro one. We've got, maybe for Andrew, we've got, how does the rising rate environment impact how Morningstar thinks about their moat ratings?
Yeah, absolutely. And so this is a question, probably not surprisingly, we're getting quite a bit now with rate hikes being so steady and clearly impacting how this asset class, the equity asset class, is being valued. So I guess the first thing I would say on that front is that, when we think about the drivers of structural competitive advantage, those 5 moat sources that I mentioned earlier, the prevailing rate environment, probably doesn't have too much impact on how we sort of qualitatively try to determine which and perhaps how many of those moat sources are present. However, when it comes to actually valuing these businesses, rate hikes do matter quite a bit more. And I'd also layer in that a related question that we get a lot is, how does the rising rate environment impact the assumed risk-free rate that you apply, and therefore the whole weighted average cost of capital that you assign to all the companies you cover? And for us, what we try to do in determining the appropriate risk-free rate and the appropriate cost of capital is we try to pin our assumptions on what we believe a mid-cycle rate environment would look like. And so, we have long forecasted that rates would rise. We certainly didn't expect them to rise, quite this quickly or actually to this level. But at the same time, I think it's very likely that this is not representative of a mid-cycle rate level. And so we've actually not had to change the risk-free rate assumptions and the cost of capital assumptions that we apply to our companies, as this path has perhaps overshot the trajectory baked into the assumptions we have. But at the same time, we still feel like our mid-cycle rate forecasts and assumptions are still very much appropriate as rates sort of settle back down towards that period. I think if we were guilty of any criticism along the way here for our discount rate assumptions, it's perhaps that rates were far below our mid-cycle assumed rate for quite some time, and only very recently started to finally move higher. But at the same time, that the fact that we've already assumed rates would rise quite a bit means that our discount rates haven't had to change across the board. Certainly, we've changed how we'll forecast cash flows for individual companies based on how sensitive their business models are to a higher rate environment over our explicit forecast period. But at the end of the day, the rate environment doesn't impact our moat ratings too much. Just really more of an important thing to keep an eye on when thinking about forecasting cash flows and actually valuing the companies.
Thanks, Andrew. I know we're just hitting the end of timing wise, but we might squeeze in one more question. Just pick one more. We might go with, you mentioned a growth bias. Can you explain, and has this changed? So I think just talking a bit more about that growth style bias you mentioned would be helpful.
Yeah, absolutely. So one really interesting element of the Morningstar Wide Moat Focus Index is that its positioning from a style perspective is very dynamic. So I know Campbell mentioned that it's dynamic in terms of its sector exposures, and the degree to which it's overweight and underweight. You know, the broad markets sector exposures can change quite a bit over time, but that also means that the style bias does change quite a bit over time. And I mentioned earlier that it's pretty consistently in that large blend style box, but at the same time, it really does migrate. Sometimes a bit more towards value, sometimes a bit more towards growth. I'd stress that's never a sort of top-down decision that we make. If we ever have a style bias one way or the other, it's not because we are targeting that style bias. It's simply the result based on the types of companies that have a wide moat and are undervalued. So for example, at the start of 2022, the types of companies that our analysts thought were most undervalued tended to be a little bit more defensive in nature. So we were very much overweight consumer defensive. We were underweight the tech sector. And then over the course of the year, as the tech sector got really beaten up and consumer defensive names held up quite nicely, there was sort of a natural progression by which some of those more defensive stocks got phased out at these quarterly reconstitutions, and some of these less defensive stocks started to get phased in. So we started 2022, with a bit of a value bias, overweight defensive sectors, and we actually exited 2022 with a bit of a growth bias, with overexposure to some less defensive sectors. And in fact, as the market rallied early in 2023, that positioning helped us. We actually, after holding up better than the market in a big down year for the market in 2022, we actually have been outperforming amid an up market early through 2023. Of course, now we're back down to almost flat year to date. So, we're still performing quite well relative to the benchmark. But I guess the point I'm trying to make is that this is dynamic and versatile. The fact that it's sort of a go anywhere portfolio from a style bias really just means that it's not a pure value strategy. It's not a pure growth strategy. If anything, we tend to migrate a little bit too early towards growth or value, but over time, that's positioned us very nicely, and it has really helped with the positive stock selection effect we've seen, and really helped with the overall strong excess returns that we've seen.
Thank you, Andrew. That wraps up our Q&A section of today. If we didn't quite get to your question, we'll make sure we come back directly to you, or if you have any more, you can email us at info@vaneck.com.au. Thank you again, Andrew and Campbell, for joining us for today. Once you do leave the webinar, you'll be directed to a quick survey. We'd love to hear how you found today, or if you have any other questions, you can send them through there. We absolutely want to hear from you. If you're looking to keep up with the latest in ETF news and hear about our next webinars, best place is to follow us on LinkedIn as well. Thank you again, Andrew, and hope you all have a wonderful rest of your Wednesday.